Hey everybody, welcome back to Foreign Currencies with Scott. I'm your host, Scott. So today we are in the middle of a trade right now, and it's just been so interesting, and there's so much to talk about with it that I thought I would start a little video here while the trade is still active. So what you can see here in the middle of the screen, which I just dropped, is the vertical line of yesterday's New York close and the horizontal line of the price at that close, which is, as you can see in the rectangle on the left, 1.34289. So as the evening went on, we can see that the pair moved away in the upward direction from the New York close. And at 3 a.m., it was pretty far away. Okay, now you can see that right at 3 a.m. there was a green candle, and let's just go ahead and mark this. So let's put in a horizontal line if we can. We'll go to drawings, horizontal, and we'll drop it right there. Okay, so what we have here is 134.75 and 134.28. So that is more than 40 pips. So that is a good entry. Now, as you can see, what has happened since then is that the pair did go down and back towards the bottom horizontal line of our two horizontal lines here. One is our entry point, and the other is the target point. So what you can see is it tried to go down, and then it went back up again, and just has not been able to quite go down far enough. You can see here at 7 a.m. it was still a ways away from that bottom line. Then at 9:30 a.m. it got closer still, but not quite there. And then it turned around 10 a.m. and made a strong up move. But I want to show you just something about this, if we can here. It's a little bit difficult on this chart to see it. All right, we're back. It's a little bit difficult to draw the chart on the phone, which is where I do these recordings. So I've drawn it in, and we're going to come back in and look at it now. So we've had a trend line that we saw the other day. Now this drawing is a channel. So a channel has both an upper line and a lower line, and they stay equal distant from each other. And I'm gonna see if just during the recording I can get in here, but it doesn't seem that I can. Okay, just have to touch that bottom line there. Now, if you look, I'm going to adjust here, and you can see that I've drawn the upper line from the peak at 3 a.m. on the far left. And then we see that we've hit points along the line at about 8 a.m. where it touched it. So it's like we're drawing a trend line there, okay? Ignore what comes after 9 a.m. Just focus on the fact that up until 9 a.m. that was the trend. Now the bottom line is automatically drawn as parallel. So I did not draw that line, I just drew the top line. Now what I'm going to do is I'm going to bring it in a bit to match the bottom point, which is that green candle with a very long wick at the end. Now we'll just blow this up. Okay. So this is similar to a trend, but it's showing us both the upper component and the lower component. And you can see that in general, the channel is going down. So if we break out of this channel, that's a good indicator that the trend is going to be broken. So I'm just going to see if I can move this down a little bit more here. Now I've messed it up. All right, we'll call that close enough. So now you can see that the upper line as it goes down hits the wick of the red candle just after 6 a.m. and then goes through 3 or 4 wicks here after 8 a.m. Okay, now as long as we stay within this channel, we will continue in this downtrend that the channel represents. As you can see, it's definitely going down from right to left. So you see that at 7 a.m. we hit that bottom mark, and we hit that without even doing anything. We only drew the top line. The bottom line just came in and touched that. So we didn't break through until 10 a.m. And then at 10 a.m., which I'll move over to the center here, you can see that at 10 a.m. we had a giant green candle, huge body that went and broke through to the upside. So if we were doing an active trade where we were watching what was going on and we thought, okay, this downtrend is broken, and if we sold, we probably want to get out here, we may have gotten out at that point. We've gotten some advantage from our entry point down to there. You can see that we've moved from, if you look at 3 a.m. When we were at 134.75, by 10 a.m. when it crosses out of the channel, we're below 134.60. So that's 15 pips that we were still down, even though we've broken through the channel at an upward rate. But we are not in that type of trade. We are in a trade where we're looking for 30 or 40 pips of a take profit with a 20 pip stop loss. Now, here's the awesome part of a 20 pip stop loss when we entered at the top. You can see that this red dashed line up here near the top of your screen, that's our stop loss. The pair would have to get up that high before we're kicked out. So even though we broke through this channel at 10 a.m. and continued to go up a bit, you can see that, and at this point I think I'll draw a oval just so that I can point again. Okay, so you can see that we definitely moved down from here to here, so it would make some money, but we're in the trade where we're going to stick with it until we lose 20 pips or make our 30 to 40 pips. So you can see that it peaked after that giant jump up right here. So not only did it not go to our stop loss and close us out, it didn't even go back up to the place where we entered at 3 a.m. Now it goes back down and then tries, now at this point the channel is done. So the channel means nothing after it's been broken, okay? We would have to come up with some other mechanism to model the behavior after that, which is a much deeper subject. But suffice it to say, this channel is now done, and now we're fearful that the pair might be going back up. But it tested that 3 a.m. price once and couldn't hit it. Then it came back down, and then it went up again. Now, this time it touches the 3 a.m., maybe even went past it a little bit, but still not really challenging our 20 pip stop loss. And then look what happened after that. It's gone down. So it's even gone down at this time right now when we're looking at it. This wick has gone below where we hit the low just before 10 a.m. So it's still got a ways to go, as you can see, to get down to this line, and this is just a wick, not the candle body. But it's been an interesting trade and continues to be an interesting trade. Now, we could get out now, and we could get out, let's see, so it's started at 75, 134,757, and right now it's at 39. So is that even 30? That would be 45. So it's over 30 pips, headed towards 40 pips. Now this stop loss line is neither 30 nor 40 pips. This is the close of New York yesterday, which we say the pair is attracted to and wants to revisit that closing price. But we could exit here, and in this particular trade, this is not in the demo account. This is a different account that I'm using for demonstration purposes, but not our YouTube channel demo account. This is an actual account. And it's up 51, and I can tell you that the stop loss for this particular trade is $48. So it's better than 1-to-1. Remember, if we touch this, we can see the whole risk reward ratio here. So the whole risk reward ratio is 1 to 1.6. So again, 30 pips is 1.5 because it's 1.5 times 20 pips. The ideal is 1 to 2, which is 40 pips. But you can see we're at, on the lower left-hand corner, we would want to get 31.5 pips. So we could exit this and make money. But remember, if we're right half the time, then if we get out on a stop loss, we're going to lose $48. You can see in the upper left-hand corner there that 20 pips represents $48. So if we continually exit early and only take $48 when we get a win, we're really limiting our ability to make money. Because if we're right half the time and we make $48, we lose $48 and then make barely $48, then we're just breaking even if we're right half the time. So it's never a good idea to exit early unless you feel like you have a good reason to do so. So one reason could be the market's going to close and you don't want to be in overnight, or you see activity that you feel is the pair is going to go in another direction. So what we have seen here is we have marked this low at 10 a.m. We have sort of gone lower than it right now with that long wick below here. But what we really want is we really want the pair to traverse down. Okay, so we're going to continue to keep this trade open and see what happens. And still at this point, anything could happen. It could go down a little bit more and close out a winner, or it could go back up, cross our 3 a.m. entry and cross the dashed line for our 20 pip stop loss and lose. But at this point, we're just going to stay and see what happens as the day progresses. So we'll check in on this later. All right, we're going to pick up where we left off here. So I'm going to draw, let's see, we're going to get rid of this drawing if we can. And now we're going to do a drawing of an oval. Okay. So we left off, we had made this low, the red candle there, and it almost got to our take profit, but not quite. And it's kind of a frustrating position because after, we talked about, we almost hit the open again. Weren't really challenging stop loss, but almost hit the open again. And then came way down again and just beat this prior low by a little bit. So looking good. And then this candle with the really long wick underneath it. So it doesn't really matter what color the candle is at that point when the body is small and the wick is long underneath it. Well, the wick is long on either side. It tends to mark the end of that direction. So we had talked about maybe manually getting out, but we decided no, we're just gonna stick it out. And it can be difficult to make that decision at the time if you're watching your trades rather than just entering them and having them automatically close out winners or losers. A lot of emotions can get involved because it's very easy to get out there and say, okay, I got enough. Didn't quite hit target, but I got enough. I'm going to get out because we can see with that long wick below the candle that it's probably going to go up again. And indeed it did. And it's no longer live because it has closed out. But you can start to, again, when the emotions start coming into play, you can start to really regret some of the decisions you've made because it doesn't show it now since we've already gone out, but this candle here has an extremely long wick, and you can see that this wick went over the entry price. Again, it didn't stop us out, but that is a difference of up above 70, 134.70, all the way down to 134.40. So that 5 minute period has 30 pips all by itself. Although the open and close were very close to each other, during that 5 minute period, the price went all the way up there. And in fact, it was negative for a bit. And you can look at your trade and say, I almost made it out. And here it is negative now. What am I going to do? What do I have to do? And this can happen. But it's very important once we have a method to stick to the method. We have some exits we can take when it meets certain conditions. But for the most part, you want to stick to the method and not let emotions come into play. Now, could this have gone up and gone closed us out? Yes, of course it could have. Did it? No, it didn't. And whenever we do see a candle with a very long wick, like we just saw one there where we wanted to get out, and that wick below it means it's likely to turn around and go up. So in this case, this wick above means it's very likely to turn around and go down, which is what it did, but not without a little bit of fireworks here. And this indicates extreme volatility when you have a small candle body and just a huge wick. So extreme volatility is not what we want when we're looking at 5 minute candles and we're just trying to get in for the day and make our position and close it out and get out. Because although we can look at this candle and say, okay, the trend is probably going to go down from here because of this very long wick above the body, true enough, but that is so much volatility that it could just easily have gone up 20 more pips, closed us out, we lose money, and then it turns around and plummets down again. So ultimately, the notion that it was going to go down would have been right, but because of the volatility, it could have pipped up and closed us out at a loss and just gone on with its day. So extreme volatility, not something we're really fond of in the when we're looking at a 5 minute chart. Now, today this did turn out to our benefit. Rather than pipping up another 20 and closing out, it did eventually find its way down, and you'll see it did cross this point, which was the closing price of New York yesterday. So we did close out a winner, so that's very good. We don't really care where it goes after that, but you can see it's still kind of trending down a bit. But if you were watching this trade, if this had been a trade you had been in and you had been watching it, it would have been quite nerve-wracking. And especially when you start trading more money, that's going to be nerve-wracking when you see say $200 here that you could have taken and closed out for the day, and then suddenly you're, negative $100 and not liking that at all, and regretting your decision. But in this case, we just stuck with the method, and ultimately it did come and close out, hitting our take profit. So again, I keep saying that, but I want to emphasize it could have gone either direction. The point here is that we want to stick with method. If we stick with method and not our emotions over the long haul, it is going to work out for us. But some days are definitely going to be tougher than others to stick to the method. So we had an exciting day today. It ended up being a winner, and we'll see what the market has in store for us next time. Until then, I'm Scott, your host for Foreign Currencies with Scott.